whole life insurance or index universal life insurance? It's the question a lot of people ask in their insurance industry, and it really depends up to you. If you want a guaranteed interest rate, if you want to have a fluctuating interest rate, what could be best? Well, we're going to break that down, the pros, the cons, the cost of insurances. So, with that being said, ladies and gents, just here to drop a few cents. You're with Earl, the money coach, with a decade license in the financial industry and 2 decades in the investment portfolio experience field. I want to break this one down because I have a lot of clients, especially one I talked to today, wanting to know the difference. But before we do that, make sure you like, follow, and subscribe. And in the description below, I have where you could get your life insurance automatically improved, health savings accounts, and for my business owners, 6 figures where you could actually get for loans to start your business. But let's dive right into it. I have my handy dandy computer here. I want to have the most up to date statistics for you guys so you know the pros, the cons, what's best for you. Now, understand this. Ultimately, at the end of the day, whole life or index universal life is a tax advantage platform, meaning all the money and the cash value gets to accumulate tax free. So you do have a cost of insurance that you take care of up front, but then all that cash accumulation gets to accumulate tax free down the road. And folks, that's huge because at the end of the day, what's 2 times 0 if taxes double? It's still zero. You're not paying anything. But people always want to know what's the difference on everything, on why people want to get whole life instead of index universal life. Well, the first thing is remember whole life is the grandfather. All right, it's been around for a while. The IULs are the new kid in the block. They've only been around for 30, 35 years. So you're now getting the data that really supports that it may be a better strategy for you. But generally speaking, when people are looking at a whole life, they're looking to have something that's guaranteed. I'm getting 5, 6, 7% every year, and I know that's going to happen. The market goes up 30%, I'm getting my 6, 7%. The market drops 20%, like we had just this month of April, you're still going to get your 5, 6%. So you kind of have a guaranteed basis, while the IULs have a floor and a cap. Now, what does that mean? The floor is zero. Zero is your hero. If the market crashes, you're still locked in. Some companies may have a 0.5%, 0.75%, depends. But generally speaking, zero is your hero. Now, you also have a cap. That's the maximum that an IUL can get. It may be 12%, 13%, 17%, meaning if the market did 20% this year and your cap is 15, you're only going to get 15%. Every company is different. They have their own strategies, their own little things that they put into there. But to break everything down, is the big thing is whole life when it came out, the primary focus was your death benefit. You wanted to have a death benefit. If something happened to you, God forbid, you're leaving generational wealth to your family. Then you have the cash value, which is very slow. It's slow and steady wins the race. Compound interest, rule of 72. Take your interest rate divided by 72. That's how long it takes your money to double. So if you're getting 1%, 1 divided by 72 means 72. It's going to take 72 years to see that money double. If you're getting 4%, 72 divided by 4 is what? 10%, 72 divided by 10 is what? That's how you figure it out. So it's more of a slow and steady package, but you really have that growth. And then ultimately, it is limited. Meaning, if you're having $200 a month, you're locked in at $200 a month from now until you're 65, 70 years old. Now, on the IUL side, you have a fluctuation where you could have a minimum, say, $200 a month, but then you could go up to say $1,000 a month, $1,500 a month. So it gives you a little bit more room to be able to save more money because it's a saving strategy. Your whole life and your index universal life, always remember they're supercharged saving strategies, not investments because they're not in the market. It's a reflection of the market. So it gives you that safety net of look, I could participate in some of the gains. I'm not having all of those losses. Now, on the IUL side, they focus a lot on having living benefits. Critical, chronic, terminal illnesses are included with the majority of your IULs. So if you have a heart attack, you have cancer, you have a stroke, cardiac arrest, you have your critical illness, your chronic illness. If you need long-term care, nursing home, nursing assistance, you get access to all that stuff. Now, the growth is faster. Why? Because you're not locked in at 4 or 5%. You can get 8%, 10%, 12%. Some of them have multipliers, some of them have participation rates. One of my IULs I had last year did 27%, while another one did 13% because they have different ways they could be structured. But you do have a higher gain you can have in those accounts. Now, we always want to know, why is it really growing? Now, here's the thing: the IUL market growth, all right, it grew 11.6% in 2024 and is projected to surpass 3.2 billion in premiums by the end of this year. So we're having, every year it's been consistent 10, 11, 12% gains on more people actually investing and looking into IULs. That's huge. Now, the average IUL return, because a lot of times you have a lot of these insurance agents talking about, oh, you can get the cap 12, 15%, 18%, they're averaging XYZ. Look, numbers are showing right now, a well structured IULs right now are averaging between 6.8% and 8.2%. So between 7 to 8% annualized returns, depending on the strategy, is what most of them are actually structured to. You can't have some that have more. You can't have great years, better years. Understand, most companies have like a 20-year track or a 60-year track showing everything. So when you look at a 20-year average, they'll tell you, oh, it's been averaging 9%, 7%, whatever it is. It's on a 20-year track, which still is not bad, because you're talking in the last 20 years, we had the dot-com bust, we had 2008, we had what just happened this year, COVID 2020. You had a lot of different things, and it's still averaging great amounts. But generally speaking, 6.8 to 8.2 is what most IULs are averaging. Now, the policy owner demographics, 53%, this is huge. 53% of new IUL policyholders in 2024 were ages 45 to 65, and they're using it as a retirement strategy. All right. So 53% of people between 45 and 65 that are investing in insurance, they're using IULs as a retirement tool because you get that tax free growth. That's huge. So when you look at a lot of these insurances, your whole life for your IULs, they have the cash value accumulation, which you actually get to use for retirement. So you could take it out as a lump sum. You could take it out so it could be annually, or structure so you could get paid out for annually, monthly basis. So look, I got 30,000 a year. I'm gonna break it down to 12 months. So a lot of different ways you could use it, but it's a great retirement tool and a supplemental income. Listen, life insurance is a supplemental income, meaning you're not using it as your sole purpose for retirement or your sole strategy. Have your 401ks, have your IRAs, have your Social Security, your investments, your real estate, have all these things, but you could have an IUL or you could have a whole life and use these life insurances as a guaranteed way to not lose money and have part of your portfolio growing tax free. One of the things I hate about the industry is a lot of insurance agents talk about IULs like it's the only thing you need for retirement. That's not the case. It's great to have in your portfolio, but don't have it as your only thing in the portfolio. If you want it to be, 20%, 30% of what you have investing in or saving strategies, absolutely go ahead. But having all your eggs in one basket is always a bad thing. So I always tell people that. So it's a huge growth. But now I'm looking at the biggest things right here is, how does it work? The IULs, there's three terminologies you got to learn. It's this taxation strategies. You have the 7702, all right, the 72E, and then you have the 101A. These are tax codes that are actually used and utilized so you could tax defer your money, grow it tax free, and have access to it all the time. So that's a great way to understand it. But the thing is, with your whole life and your IULs, understand there is a COI, cost of insurance. You're going to have a little bit that you have to pay up front while you actually have your insurances to take care of the cost of insurance. Now, one thing you have to understand when you have your IULs is they call it increasing. So it's an increasing death benefit. So you get your cash value plus a death benefit, it's always increasing. But as the death benefit is increasing, the cost of insurance they might actually go up. So you have to make sure that you switch. Once you get into retirement, 62, 65, 67, you want to switch your insurance from an increasing strategy to a level strategy so that cost of insurance stays locked in. And if it was properly structured, you took care of that cost of insurance in the first few years. That's a huge thing. A lot of times when you see these insurance strategies, they're not structured correctly. And how do you structure it correctly? There's multiple ways, but the number one thing is having overfunding in this strategy. life insurance, especially your IULs, because the whole life is fixed. You got $200, you put it in $200. Your IULs, if you have a $200 minimum and $1,000 maximum, you don't want to stay at that 200 a month. You want to use it and be putting in more. They call it an overfund. You want to be maxing out your strategy. This actually amplifies what's going towards that cost of insurance up front, and it allows you to take care of the cost of insurance a lot quicker. So if you're not overfunding, if you're paying the bare minimum, if you got a IUL life insurance in the last 4 or 5 years and your insurance agent has you paying the minimum, $100 a month, 250, whatever you're paying every month, if you've just been paying that target, guess what? It's going to take you 13, 14, 15 years to take care of that cost of insurance. Now, when you max fund it and you're overfunded and structure it correctly, you can knock that out in the first 4 to 5 years. I've seen some companies could do it quicker. On average, I've seen properly structured max overfunding between 4 to 5 years, sometimes 6 years. So you want to make sure it's structured correctly so you take care of that cost of insurance. And then misconception. One of the big misconceptions is, how do I actually take this money out? If it's from a whole life insurance or if it's an IUL insurance, you have a withdrawal and then you have a loan. So what you want to do is loan that money out to yourself, loan the cash value out to yourself. And what they do is they have collateral already, so you don't have to worry about collateral. A lot of times when you get a loan, when you're buying a car, you use your car as collateral. You do something on your house, you use your house as collateral. But in life insurance, they can use the death benefit as collateral. So if you have $500,000 of a death benefit and you have $100,000 of cash value, say you want to take out 50,000, they're going to take out that 50,000. They're going to use 50,000 of that death benefit as collateral. So if it's not paid back the loan within your insurance, when you pass away, they just deduct it from that life insurance. So if you have 500,000, like I said in this example, they'll take out 50,000, and then your beneficiaries will get that 450,000 plus whatever is remaining from the cash value. So it does come as a collateral as you loan it to yourself. Now, when you start withdrawing it, if you use it as a withdrawal, especially a lot of times you hear these folks talking about infinite banking, family banking, becoming your own bank, where they front load a lot of money, which is possible. You could do it, not a problem. But if you're front loading it and you haven't taken care of some of that cost of insurance and you want to withdraw that money quickly so you could, buy an investment property or something else, you can be subject to having some kind of form of cost or taxation, depending on how that money literally has been used. So you want to make sure you know how you're doing it correctly so you don't get penalized. So at the end of the day, both strategies are great. Whole life gives you consistency. Your IULs may give you where you have a little bit of leverage to play in the market, but you don't know if the market goes up. You don't know if the market goes down. Personally speaking, I have both kind of strategies. I have a whole life. So if I want to have something I know no matter what, right now, 2025, the market's been all over the place. I'm still going to get 6.3% in my whole life. Doesn't matter what. Then I also have my IUL strategies where I did, like I said, 27% last year. If the market does bad this year, I'm still locked in at zero. So it's great to have an option where you can use both kinds, and you want to make sure you know what you're actually structuring everything for. Because the big thing is, it's not about what permanent insurance is better. It's about how you're going to A, utilize it, and B, make sure the beneficiaries and everything is in play. So, in that being said, folks, just wanted to have a quick breakdown. In my opinion, I say the IUL could get you more income. The whole life could get you a little bit more guaranteed income, but make sure you use it correctly for yourself. And make sure you like, follow, subscribe the page. And I'll see you on the next video. Take care.